All right, so we talked about CDs. Now let's talk about stocks. And we'll go into a lot more detail with stocks later on. But for now, let's give you some basics. So owning a stock means you own part of a company. It's considered high risk. And you gain money when the value of the company increases. And when you sell the stock, or if you get dividends. So let's just look at a stock together. All right, so we're looking at Deere & Company. So today, the market started open, and it started off at $134.54 for, or approximately, for a share of Deere & Company. So if you bought that, you would now own John Deere, a piece of John Deere. Now, of course, something happened throughout the day. It went down, and now it's gone up a little bit again. So again, this is today so far. It's gone down. Now, if you want to gain money, you gain money by buying low when the price is low, like $132, and then selling it when the price is high, when it's $133. And that way you make, like $1 profit. And so that's one way in which you make money. The other way in which you make money is the dividends you might make. So if you own John Deere, some companies provide dividends. And so it mentions here dividend dates and forward dividend yield. And we're not going to get into that specific, but again, that's the other way in which you make money is through dividends. So what is a dividend? Let's look at that. So dividend is the money a company will pay you if you own stock in their company. So few companies pay dividends nowadays. When they do it, it only happens when they're making profits as a company. So my guess is a lot of companies right now, what do you think? Are they paying dividends or not? The answer is they're not, right? Because the economy is not doing so good. So there's less likely to have so much profits. So let's take a moment and let's watch two videos, one explaining what is a stock, some more, and then what is a dividend.
Presented by WallStreetSurvivor.com. This is Julie. She lives in Paris. Julie is known for her delicious croissants. She started baking when she was a little girl, and ever since it has been her dream to open a bakery of her very own and supply the city with her wonderful croissants. She figures that it will cost her $100,000 to start her business with all of the supplies, staff, and costs of starting a business. The problem is Julie only has $10,000 to put into her company. She definitely can't build her business properly on $10,000. What is Julie to do? Julie decides to issue stock to investors to help raise money. Stocks are pieces or shares of ownership of a company. Each share is worth a certain amount based on what the company is worth. Companies issue shares to investors in order to raise money. Because she is $90,000 short, Julie decides to get 9 of her friends to invest in the remaining balance. However, to do this, Julie must give up 90% of her company in shares. Now Julie and her friends each own 10% of her company. 5 years later, Julie's bakery is booming. She has turned her bakery into one of the biggest in Paris. Her company is now worth $1 million. Julie got the money she needed to create her business without acquiring additional risk or debt. Also, Julie and her 9 friends each turned their $10,000 investment into $100,000. Just like Julie's friends bought shares in her company, you can also buy shares of publicly traded companies like Apple or Walmart. If Apple has 100 shares and you bought 1 share, you would own 1% of Apple. To learn more about the stock market, sign up at WallStreetSurvivor.com and play the web's biggest fantasy stock market simulator.
A dividend is a cash distribution by a company to its shareholders. Let's look at Al's Ice Cream Shop. To open his first shop, Al gathers money from investors and issues shares. Al's ice cream is a hit, and sales skyrocket. Al uses the company's profits to open up more and more shops. Soon Al reaches the point where his ice cream shops are competing with each other for sales. This is known as market saturation. Instead of opening more shops, Al decided to focus on keeping sales strong at his existing shops. Profits continue to roll in. Al now has the choice between investing his profits or simply paying them out to the shareholders. Al knows he can sell ice cream. He's not sure he can make a profit investing, so he decides to pay out some of his profits directly to the shareholders. He holds back some profits in case of an emergency and pays out all the cash he doesn't need to run his business. This cash is a dividend. It can be increased or decreased yearly according to how Al's business performs.
All right, so hopefully you now understand stocks and dividends a little bit more, and we will go into even more detail later yet. By the way, we have so far CDs and stocks. Let's talk about another asset, bonds. And so a bond is a debt instrument by which a company owes you money. You get a return from the interest rate paid to you. So let's say I want to grow a business, and so I got my business going, and instead of selling stocks, which means other people own my company now, I might sell bonds to people. And when I sell the bond, I get the money that I can now go and invest in my company, right? But this time, the negative is that instead of people owning my company, I owe them money back. Basically, I take a loan. That's what a bond is. You're taking loans from people. And so you have to pay them back. And of course, if you're kind of, a new guy on the block, people don't really know if they trust you or not. So they might charge you a higher interest rate when you try and sell a bond to them. They want, a lot of money, a lot higher interest paid out because they don't really trust you. Now, of course, if you're an established business and you've run multiple businesses, multiple locations and things like that, and you want to sell a bond, well, then you might be able to charge a lower interest rate because people can trust you. You're not as risky. And so, of course, there's business bonds, and then there's also government bonds. Government bonds are super safe because the U.S. government has always paid their bonds. They've never not paid their debt. So when the government wants extra money to spend on a stimulus or something like that, then they might sell a bond to then get that money. And so it's considered super safe because it's low risk, because the government can always pay people back, because all they have to do is print money and voila, they can pay the bond. So very low risk in general, although some of those commercial bonds, those business bonds, can be more risky. It just depends on which one you're going for. But we consider bonds in general to be low risk, low return investments. Now, mutual funds, before I explain it, let me have you watch a video that explains it for you.
Presented by WallStreetSurvivor.com. A mutual fund is a collection of stocks, bonds, cash, and other securities that are managed by a professional. Generally, people buy mutual funds because they want a simple way to invest in a diversified portfolio with the security of knowing that someone will be watching it. Here's an example of how a mutual fund works. Here's Will. Will has been investing for a long time with consistently awesome returns. People are always asking him for investment tips and financial advice. So Will decides to start a fund where he will manage and invest for people. He registers with the authorities, gets the approval, and sets up a mutual fund. He calls it Will's Fund. Because Will is such an awesome investor, he is able to convince 10 people to invest $1,000 in Will's fund. Each investor owns one share of Will's mutual fund. Each share is worth $1,000. This is referred to as net average value. With the cash, Will invests in some stocks and bonds and leaves a little left over in cash. This portfolio is referred to as his assets under management. Will also takes a small percentage of the fund as his fee. This is called the asset under management fee. Let's fast forward 3 months. Will has made some really wise stock decisions. He was able to grow the portfolio from $10,000 to $11,000. Because he made an additional $1,000 and he has 10 shareholders, each of Will's friends will make $100, bringing the net average value of the mutual fund to $1,100. Will's fund is an example of a close-ended fund. He raised the money for his fund through his friends and is not accepting any more funds from outsiders. If one of his friends wants to sell their position, they would have to trade it to another investor. Mutual funds are traded on the stock exchange. To learn more about mutual funds, check out the Learn Center at wallstreetsurvivor.com.
All right, so mutual funds. Would you trust me to be your mutual fund manager? How about I take $100 from all the class and I'll go invest for you guys? We'll call it Mr. Hansen's Mutual Fund. What do you guys think about that? So that's basically what a mutual fund though is, right? Where you trust someone, you give them money, and they go invest for you. That's a professional who does it. Maybe I'm not professional enough. Either way, you make money as from this investment as the investor. The things he invests in go up or down, or you could lose money if the things he invests in go up or down. And it's usually considered a relatively good long-term investment. A lot of investors, Mr. Hansen, would highly recommend that you do mutual funds because it's a sort of a medium risk sort of investment. Some people would consider it higher risk, but it's, in my opinion, it's a good risk to take. So anyways, of course, the risk though also depends on what type of mutual fund you invest in. So let's talk about the different types of mutual funds for a second. So there are growth stock mutual funds, sometimes called mid-cap or equity funds. And then there's growth and income, large cap, blue chip, and then there's aggressive growth or small cap. So what's the difference between these three? I'll talk about international and global in a second. So the difference is blue chip are big companies, small cap are small companies, mid cap or growth stock are middle companies. How do you know the difference? Well, the definition of a mid cap company is its value is between 2 and 10 billion. So I went on Google Images a while back and I typed in large cap mutual funds, and these are some of the companies that it showed me. I also Googled mid cap companies, and these are some of the companies it showed me. Now, do you think Google Images is a perfect test for whether a company is large cap or mid cap? Probably not, right? So let's actually go to the stock exchanges and look at the value of these stocks, these companies, and see if whether they're considered mid cap or small cap. So let's take a look now. All right, so Under Armour selling for $8. Its value going down today as a stock, but the company as a whole, the market cap is $3.82 billion. So does that make it large, mid, or small cap? I told you mid cap was between 2 and 10 billion. So is Under Armour large, medium, or small? The answer is it's medium. It's a mid cap company. Although let's look at the year to date. Back before the coronavirus, it was at 18. Now it's dropped down to 8. So it's definitely dropped half its value. So even if we added half of its value, even if we doubled it, it still was a mid cap before the coronavirus hit. So that's one company. Let's look at another one. Let's look at Deere & Company again. So Deere & Company, its market cap is 41 billion. That makes it a large cap, right? Because it's above 10 billion. Let's look at another one. Let's look at Land's End. My favorite example because my wife used to work there. So the market cap is 239 million. So it's not even billion. So what does that make it? It makes it a small cap, right? Let's look at Eastman Kodak Company. Market cap 121 million. Kodak used to be a big thing back in the day, but it's actually um, really small now. So it's be considered a small cap. But let me just look at something here. You see what happened here? All of a sudden, January, it jumped up, um, and February, I heard, I don't know for sure. Someone told me that there was um, the Kodak company has some medical um, that it owns now. It's no longer just all about film and photography. It was known for that back when we used to use film and cameras, but now it's gone more to medical. And so part of the coronavirus, um, there was some cure that was this that was being worked on from the Kodak company, and so that's I think why there's a high. It's been high up here during the January and February when it was really bad in China. Um, so, anyways, either way, it's still considered a small cap. Now let's look at another company. This is Sears Holding Company. This was a huge company, but now 78 million. So back in the day when I first looked at Google, this might have been considered a mid-cap company, but now it's a small cap because it's not even $1 billion. Back in the day, it was definitely a large cap, but it has since fallen all the way to a small cap. It's kind of crazy. Ford Motor Company, its market cap is 20 billion. So that would make it a large cap company, right? So you can do this yourself. You can go to Google Finance, type in any company, and you can find out what its cap market cap is, and you can find out whether it's large, medium, or small. Last one, let's look at Electronic Arts, EA, and they are worth 34 billion. That makes them a large cap, although they might have been a mid cap when I first looked them up, and they've since grown since then. So again, this shows you how companies can be big and go to small. Stocks are very risky. Of course, now mutual funds are considered less risky. Now, why are mutual funds considered less risky? Because they don't just buy one company. They don't just buy Sears. If it's a mid-cap mutual fund, it invests in multiple stocks. And so if a mutual fund invests in multiple stocks, if one goes bad but the other one does well, then the fund can overall be good. So there are, again, small cap, which are small businesses, mid cap, medium-sized businesses, large cap, large businesses. But again, there still are international and global mutual funds and lots of other ones as well. But international would be ones that focus on international companies. So right now, America's economy might not be doing so good, but maybe Africa's economy is doing well. And so if you're invested in an international mutual fund, you can, hopefully have a balance in your investments. And a global mutual fund would be one that invests in U.S. and international companies. So that's even more balanced, maybe. And so a lot of investors suggest that you diversify. So you put, 25% of your assets in international and global to get some of the overseas growth. Put 25% in mid cap to be, get some middle of the road companies. Large cap, put 25% of your money in those more stable companies, again, relatively stable companies. And of course, small cap, put 25% in there so you can get some of those crazy highs that from those little companies that start off little and explode to something big. So now, why should you do this? Why should you put your money in all these different assets? Why should we call it diversifying? Let me show you why.
Don't put all your eggs in one basket. Diversify your investments with JP Group Financial. Placing all of your trust in one investment can be a recipe for disaster. A diversified portfolio spreads out your assets to reduce the risk of overall loss. Call today and let JP Group Financial work for you.
So that is why you diversify, because you don't want to put all your eggs in one basket. So in case one company goes bad, you're up a creek without a paddle, right? You want to diversify so you can still do well if some part of your investments goes bad. Now, let's talk about a few more assets you can invest in. There's rental real estate, known as being a very risky thing, where you buy a property and you rent it out to other people. The reason why this is really risky is what happens if the person you rent from loses their job and can't pay you rent? Then you're in trouble. You're going to not be able to pay the mortgage, and then the bank's going to call you up and say, "Hey, we're going to repossess the house." And so it can be very risky to do rental real estate, and it's considered it's one of the least liquid investments, um, because it's hard to sell these places sometimes. So rental real estate is another asset you could invest in. Annuities is another type of investment. It's like a savings account with a bank, but in this time, instead of putting your money in a bank, you're putting your money in an insurance company. And there's two types. There's fixed and variable. The fixed is like a normal like CD savings account, except for a fixed will give you a higher interest rate than you would get a CD at a bank. Now, why would they give you higher? Well, because it's not insured by the FDIC. There's more risk involved, right? Now, a variable is like a mutual fund that they're going to give, if the economy is doing well, stocks are going up and things like that are going up, then they're going to give you a higher return for the money in that variable annuity. If things are doing bad, they're going to give you a lower return. And of course, there is a benefit to variable annuities, and that is that they grow tax deferred. That you can put money in there and you don't have to pay taxes on that money in there as it grows. So that's an advantage to an annuity. And it's considered relatively low to medium risk investments. Again, it depends on whether you're choosing fixed or variable. And if you're choosing a variable, is it going to be, it's basically like a mutual fund. Is it going to be invest in riskier things or less risky? But in general, annuities are going to be considered more low to medium risk. Now, your homework is going to be to look up the difference between traditional versus Roth IRAs, which are similar, that they have a similarity to the annuities. And so we'll talk about that next time as we talk about stocks as well. Okay, last investments to go over. Gold is an investment. It's considered a commodity. Some people say, invest in gold. It's the most important thing you should invest in, especially when the economy's in a depression. Everyone wants to buy gold in case things go bad, and so however, it's considered very high risk because gold, just like stocks, go up and down in value like crazy. If another gold mine is found, then the supply increases and the value goes down. Or if a lot of companies go out of business who were buying gold, then to make some electronics or something like that, if they go out of business, the demand goes down, prices go down. And so anyways, gold can go up and down in price, just like the stock market, which makes it very risky. And if gold goes all the way down to like where no one cares about it anymore, then all you're just stuck with is this metal. All you can use it for is metal. And it's not even, gold isn't a good thing for metal per se. And if you're an investor and you're not an electrician, gold doesn't do much good, especially if it loses its value completely. Whereas if a stock loses its value, it's a little bit better than gold because you still own a company. So if you own enough of the stocks, you can control the company, and potentially you can, if you own more than 50% of the company's stocks, even though the value might be really low, you can control the assets in that company and sell off the assets and still make some money off of that stock, off of owning that company. Whereas gold, you just own gold. That's it. If it's worthless, it's worthless. So that's why gold is considered high risk. Commodities and futures are a little bit less risky because you're not just buying one asset, one commodity like gold. You're buying gold, silver, platinum. You're buying grain, meat, um, uh, soybeans. I mean, these are all considered commodities. And so you're buying a diversified amount of commodities. But still, it's considered very high risk. Just like stocks go up and down, so do the um, the value of these commodities. Um, and so, anyways, there's commodities and futures, and maybe we'll talk more about futures in the future. But commodities is another high risk investment. Day trading is where it's not necessarily an investment. It's an investment style where you buy stocks, you buy gold, you buy commodities, you buy them one time of the day and you sell them another time of the day to try and make money. It's super high risk. 88% of people lose money. 70% almost lose all of their money. And so that means a very small number of people actually make money off day trading. That isn't to say buying stocks or buying these commodities is a bad thing. It just means that you probably don't want to buy and sell on short notice. You want to buy and sell longer term. That's more of a wiser investment strategy. And of course, the last investment we're going to talk about, there's lots of other ones out there, but this is another one, is viaticals, also known as life settlements. Super high risk and it has many scams. And so basically, with viatical, you buy someone's life insurance policy. So let's say you bought Mr. Hansen's life insurance policy, and let's say I'm an old guy with no friends, no kids, no wife. So I'm okay with selling you my life insurance policy because, you know, my wife, she left me or something like that, and my kids all died off, and so I'm left here with this life insurance policy. I have no one to give it to, so I'll sell it to someone, right? So my life insurance policy says when I die, I'll get 200,000. So someone of my family get $200,000, but I've been paying into this life insurance policy my whole life. I don't want to just um, not get anything out of it, so I'll sell it to you, right? I'll sell it to you, and I'll sell it to you for, let's say it's it's going to get you 200,000. I'll sell it to you for 100,000, and that way I get some money from all this money I've put in my whole life, and then I'll go off and live my life. And when I die, you get 200,000. But of course, you will have to wait until I die. Of course, then it might seem kind of shady because if I sell it to you, what might you try and do to me? You might try and kill me, right? So viaticals could be very tricky because you want to, if you sell your life insurance to a viatical company, you want to make sure that they have strict um, confidentiality so that whoever is buying my life insurance policy doesn't know they're buying Mr. Hansen's life insurance policy, so they don't come hunting me down and killing me, right? Of course, there's also lots of scams here because I might say, you know what, I've got cancer, I'm gonna die, so I um, decide to sell my life insurance policy, and I tell them, oh, I'm gonna die in a month. I just want to get something for my money and go to the Bahamas and have a good vacation one last time before I die. So I do the same thing. You give me $100,000 and off I go. And I'm actually a healthy person. No one knows that I lied except for me. And you have to wait a long, 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 long time before you ever double your money. You could have put your $100,000 into some other investment and get way more money out of it than waiting for me to die. And you'd be like, but you lied. Yeah, but I'm in the Bahamas. I'm living my life up down there, and you can't get me because I'm not in America anymore. Um, and so anyways, there's lots of scams. And there's even more scams than what I'm mentioning. So very risky investment. So how do you figure out what type of investment to invest in? Well, you have to think about what type of person are you? Do you want to be a person who invests in high risk things or low risk? Do you want to be someone who invests in a little bit of both or just medium risk things? So that's part of your homework is figure out what asset are you going to invest in and what strategies are you going to use? And one other thing I forgot to mention, your other homework is to find out the difference between traditional versus a Roth IRA. Peace out for now, guys.